Hello and welcome to today's lesson. So what you're going to be discussing today is a trading plan example. So by now you've already known your trading style, you know how to use the economic calendar, and then you know when not to trade, when not to engage. You have already defined your risk management model. Now what you're going to be looking at is a trading plan example. Using all those concepts, we can now start developing our trading plan. And from this trading plan, this is what we're going to be using to backtest, first of all, to tape read, and then to demo trade before you can engage or even think about engaging in a live trading environment. So this trading plan will be used specifically for demo trading until you gain consistency. And when you're ready, that's when you can decide on your own if you want to do live trading. So to begin with, we already looked at trading style guidelines. So in today's example, I've specifically chosen the day trader trading style because this is an example, so I have to focus on one of these trading styles. And I've gone with day trading because that is the one that falls somewhere in between all the trading styles. So this is just an example. It does not limit the use of any other trading style, or the concepts that I'm going to showcase here will not be limited just because I've chosen the day trader style rather than any other. So you can just formulate your own plan based on the guidelines here, based on now your trading style. So as we already looked at this is a day trading example. So this is just a brief summary of what a day trading style looks like. So the profile of the trader is that the personality is impatient and they find time in short-term intraday risk. The trader has a smartphone for instant updates and order entry and stops management. And price alerts are sent via notifications to alert when orders execute and or scaling thresholds are reached. So the optimal model actually is that you're doing intra-trading between 1 to 5 hours in duration per setup. The time available is open to market conditions. The session of focus is London and New York sessions. And then your trade objectives per trade is between 40 to 50 pips on average. Trade frequency is 3 times per week. And the trading days of focus is Monday, Tuesday, Wednesday, and sometimes Thursday. So actually these conditions may change significantly depending on your trading style of choice. So I've already outlined that in this example I'm going to be using day trading style, but you can adopt any form of style depending on your personality or lifestyle. So let's just get deep into the model. So actually this is one of the most fundamental tools as a professional trader that you must have. So the reason I'm putting this even as the last bit of the course is because once you understand the concepts that we've already outlined, that is when you can now come and create a trading plan. So the assumption is that at this point you already understand the concepts. So even if you're just going through this for the first time, it's okay, but you need to go back and listen carefully to those concepts, backtest them, study them in your charts before you even start adopting any form of trading plan, because it is crucial that you understand the concepts first even before you start creating your trading plan. But now this is the assumption that you've already understood all the concepts as taught, and now you're ready to create your trading plan. So this model, I've adopted the entry pattern number 1. So we looked at trading patterns, and in this example I'll be using the entry pattern number 1. So the process actually begins with identifying a higher time frame, either 1 day or 4-hour order block or fair value gap. So that order block or fair value gap must be hit. that is from the higher time frame. So, and then before even you identify that order block or fair value gap, you already know how to define your daily and weekly bias. So you'll be seeing, actually you'll be touching on that towards the end of this lesson. But this model, it begins once you understand the bias, and then now you come to focus on that order block of fair value gap that has been hit. So the second thing is that you have intraday session, which is the London or New York sessions. So this is now where time comes in. So the time you already talked about, the time of day and day of the week, of course, is now comes in as the second thing you want to look at. And finally, you look at the trading pattern formation. So any of the two ideas that have come together, then if you find that entry pattern, then you're good to go. So let's get deeper into how you can formulate your trade setup. So this is just a recap of the framework for entry, which is the entry pattern number 1, which you already outlined in previous lessons when we looked at entry patterns. So this is actually what you need to see in order for you to begin hunting for trade entries. So this is a pattern that you need to backtest and get very familiar with. So in this example, we have the bearish example. It comes towards that key level. It could be the daily or 4-hour order block of a value gap, then falls short, then now comes and hammers that level, taking out this buy side liquidity. Then immediately you see a reversal, and then once it reverses, you want to now enter when it comes back to retest that area where you saw a market structure shift, and now an imbalance has been left here. So you'll be looking at even very specific examples so that you can get a clear picture of what we're talking about. So you take your entry there, and then you target sell side liquidity. So on the bullish end, it's just the same thing, but now it's reversed. So it will take out sell side liquidity, hit that key level, then take out this sell side liquidity. You want to place your stop actually below that low. So once you see this reversal with a break in market structure, or rather shift in market structure, you want to hunt for entries right when it comes towards that market structure. Sometimes you might not really get exactly at that point, but you want to take your entries near there coupled with a fair value gap. So this is an example of what you're talking about. So this is a bearish example. So actually these are setups that repeat multiple times. They repeat almost every day and every week. So you'll not get it every day, but it repeats at least a couple times a week. So we want to really backtest these concepts and setups that I'll be outlining in this example. So just as an example, we have that 1 day fair value gap, which is now our key level. So I've outlined this session. So we have the time also. This is the New York session. So we saw the market actually come higher. So it was targeting actually to hit that midpoint of the fair value gap, which is our key level. So it came higher, fell short of that midpoint, then started dropping. But this drop was just a fake drop. Then it rammed higher and took out this buy side liquidity. So once you take out this liquidity, you don't force that the market will automatically reverse. What you do is wait that after that high has been taken out, what happens? Does it come and take out this short-term low? So once it takes out, look at how aggressive. So it will be obvious. And as we talked about bank sponsorship and order flow, you'll see that order flow is being respected, going lower. So, and then you'll see bank sponsorship like this range here. This is the range you're waiting for once we take that buy side. So once it takes out that buy side, you want to wait for that reversal. Once you see this reversal, that is your confirmation that now this market is willing to come and take out this sell side liquidity. So this is really a range of opportunity where you'll now be looking to be a seller here. So that's why I'm indicating this as the entry inside that fair value gap and near that break in market structure, or rather shift in market structure. Then you're targeting this liquidity. So you can even use this low as a point of taking out some partials, and even this low down here. Bullish example will be where we had this 4-hour order block right here, which is our key level. So once we look at how it falls short of that key level, so you want to actually see that level being hit. You don't want to see it just fall shy of it, because that will be the fake move. So it will begin a fake move, leave that high, then drop and hit that level while taking out the sell liquidity, and then immediately you want to see the market shifting higher, leaving imbalances. So this is bank sponsorship. So once you see this shift in market structure, that is your confirmation now that the market is willing to come for these highs and even higher targets. So we had another high on the left side of the chart, which we have not seen here, but there's a high there, and this other high. So that was the initial target. The first target was here. This could be a point where you take some partials, and then once you get to the final target, you could book your profits and maybe leave a runner there if the market is willing to expand even higher. So our entry came at that. This is a 30 minutes chart. So our entry came in at that 30 minutes fair value gap during the London session. Now this is where now you start developing your trading plan. So what you have looked at is just a rough idea of just an example of maybe how it will look like, but now we're going into the step-by-step guideline of what you want to specifically look for when developing a trading plan. So in this example, as you can see, we start with preparation. So preparation is you prepare yourself, and mostly you do this during the weekend. Prepare yourself for the week ahead. Then we now start looking at opportunity discovery. Then you plan your trade. Once you plan a trade and everything comes together, you execute your trade. And then once you execute, you want to be looking at managing your trade. So you look at all these concepts so that you can clearly see what they entail and what you need to be doing every single time before you enter any trade, or even before you execute, or rather what you even need to see in the markets. So the first thing is preparation. So under preparation, the first thing you want to be looking at, so this can be done actually every weekend, preferably when the market is still silent. So you want to check the economic calendar as we outlined. You focus on the high impact news during the upcoming week and the low impact news. So this will give you an idea of which day of the week to focus on for looking for setups, because when we have high impact news and medium impact news at specific days, it means that movement in the market will increase during those specific days. So check your economic calendar, and then the second thing you want to do is determine your weekly bias. So we already looked at how you can do that. Then thirdly, you want to determine your daily bias. So once you have your weekly bias, your daily bias should be easy to find. And then while determining the daily bias and weekly bias, in your analysis, you want to outline weekly and daily highs and lows. So previous week's highs and lows are very important to monitor, because those are areas where the market will seek for liquidity. And once we take out liquidity, that could be the starting point of a setup, or even it could be a target that you're looking at, even as a drawn liquidity. So other things you want to really outline and annotate in your charts is the fair value gaps and the order blocks, of course in the weekly and daily chart, and some nearest 4-hour order blocks or fair value gaps. So make sure you're focusing on the nearest and obvious. So the nearest, when I say nearest, I mean nearest to price. So you want to anticipate now price. Once you have outlined all these elements, you want to anticipate that price will move into those weekly, daily, or 4-hour order blocks, or even fair value gaps, in the direction of the weekly or daily bias on a day that you have an economic event. So it has to be high impact or medium impact only. So we want to set alerts at those levels. So once those levels are hit, then our interest now should shift to now start observing what the market is doing and see if we have any opportunities to engage in that market. So you look deeper into how you can now know that the market will respond and what you need to do. Opportunity discovery. This is the second aspect of your trading plan. So you want to identify previous day's lows or intra-week lows, session lows, and also discount order blocks and fair value gaps when the bias is bullish. So when the bias is bullish, you're looking at discount order blocks or fair value gaps, and you want to identify this previous day's high or intra-week high, session highs, and premium order blocks or fair value gaps when the bias is bearish. So actually this will be a range of opportunity. So you want to expect a daily range expansion in the direction of the weekly or daily bias. So actually that's what you'll be looking for in terms of classifying your opportunity discovery. So this is just an example. So when you look at this, you can see that we have a premium fair value gap. We had a premium fair value gap up here, and we had a discount fair value gap down here. So the market had hit this premium level. We actually saw the market immediately reverse. So during this week or day, you want to focus on now this discount fair value gap that the market will be aiming for. So this will be a range of opportunity. So this is actually a range of opportunity that you want to now monitor for setups as the market is dropping into these levels. So I've also outlined the price range from this low to high. The 50% was right here, so this is also a level where the market was seeking to come back into, and we also had sell-side liquidity here. So the market was actually driving towards this level. So that is your range of opportunity. So once you identify that range of opportunity, you drop into the lower time frames to now find scenarios where the market will want to continue dropping towards this level. So we shall start by looking at a bearish trading plan, or trade planning rather. So this is a bearish scenario in the market. So actually I'll be providing an example at the end of this course, where I'll demonstrate in a video where we'll look at an example and a backtesting example where this entire process has been done for you, just as an example. So in this video I'm just going through that process. You can check out the video after the end of this video. So you need to really understand the basic idea first, then you can check out the example at the end of the video, where it outlines the entire process that you can follow yourself, and even formulate your own methodology in order for you to create a trading plan, or even adopt a trading, I'll say, routine of sorts. So the first thing we'll be doing, we'll want to sell 1 day or 4 hour chart premium order block or fair value gap, coupled with London open session or New York open session. So let's say, for example, when you're bearish, you'll want to be using the 15 minutes entry pattern number 1 to frame your entries. Then we'll frame a sell entry when the price moves up into a 15 minutes shift in market structure after hitting the market should have hit that 1 day or 4 hour bearish order block or bearish fair value gap, and then you want to sell at that 15 minutes shift in market structure. So actually look at an example of how that looks like. Then we'll want to aim to capture the high of the day. This is when you're bearish during London open or New York open session, when the daily bias is bearish, or even sometimes you can get a New York open session bearish reversal. So we'll use also the 5 minutes entry pattern number 1 to fine tune at the potential turning point to reduce risk. So we aim to enter when the market is in a premium. So remember, you are selling in a premium and you're buying at a discount. So in this scenario, because we are bearish, we are selling at a premium. In terms of targeting, you want to target sell side liquidity below your entry, and the next logical discount order block or fair value gap at 40 pips will be the initial objective. Then use the lows that frame 40 to 50 pips as your targets. And also the final thing, you want to aim for setups that allow for 3-to-1 reward to risk kind of scenario. Sometimes it may not really get to 3-to-1, but at least aim for that. If you get something closer to that, then you're good. So you want to really do that because it will help you in your money management. This is just the opposite, which is the bullish scenario. So what we'll be doing, we'll be buying the 1-day chart discount order block or fair value gap coupled with London open session or New York open session time. So when you're bullish, we'll use 15 minutes entry pattern number 1 to frame our entries, and then we'll frame a buy entry when the price moves down into a 15 minutes shift in market structure after hitting a 1-day or 4-hour bullish order block or bullish fair value gap. Then we'll aim to capture the low of the day during London open or New York open session when daily bias is bullish, or it could be a New York open session bullish reversal. We'll also use the 5 minutes entry pattern number 1 to fine tune at the potential turning point to reduce risk. So we aim to enter when the market is in a discount, and our targeting, you're doing your targeting buy side liquidity above your entry, and the next logical premium order block or fair value gap at 40 pips will be the initial objective, and also use the highs that frame 40 to 50 pips. Aim for setups that allow for 3-to-1 reward to risk. So that is how you can plan your trade, and after planning your trade, ensure that you're following your plan. So in terms of execution, now you have planned your trade and now you have seen a setup. So what do you do? So trade execution is now it shows you what to do once, or how to even place your stops and your targeting once you identify or plan your setups. So the 15 minutes or 5 minutes will be used for execution, and then the 1 week or daily chart will be used for determining the direction. You can also use the 4-hour for more opportunities to find more order blocks and fair value gaps that you can use, but do not use it for direction. Use the weekly and daily chart for direction. So once you have the direction, maybe it's going down, you find order blocks and fair value gaps that will support the movement to go down. So that's how you use the 4-hour chart. So when do you trade? You'll be focusing on Monday, Tuesday, Wednesday, and Thursday. So I've excluded Friday here because it's a low probability day, and it's also typically a small range day. Sometimes you'll have big range, but very rarely. Where do setups form? Setups, as we already outlined, they form in the weekly, daily, and 4-hour fair value gap, order block, or liquidity run. So those are the 3 places we'll be looking for setups. So what do you do? When you're bearish, you'll want to use the 15 minutes entry pattern number 1 to frame our entry once a premium 1-day or 4-hour order block or fair value gap is hit. So once you see the 15 minutes entry pattern number 1 confirmed, and as I've outlined here, the confirmation is the market structure shift, you enter on the retest of market structure shift area coupled with a fair value gap. So sometimes it may not get to the market structure shift area, but you want to couple that with a fair value gap for confluence. Then you can also reduce your risk by using a 5 minutes entry pattern number 1 for entry. So sometimes that pattern will form in 5 minutes. You can use that to reduce your risk even further. So what you want to do, because you're selling, sell when the market is moving up into premium as it retests that fair value gap or market structure shift. So you'll have that price range that created the market structure shift. So that range is what you can use now, as we outlined in terms of premium and discount. That range, you can measure that range and determine the discount area below 50% of the fib levels. That is where we'll be actually not below, because it's premium, it's above 50%. So above 50% is your premium area. You want to be selling when you're in premium. And then you want to target sell side liquidity. Actually target sell side liquidity on the 15 minutes or previous day's low. So once you take that entry, target sell side liquidity because you're bearish. Aim for 40 to 50 pips, and you want to aim to catch that daily range expansion, but do not over target. Just aim for 40 to 50 pips, because as a day trader that is good enough for this trading. And you want to place your stop loss above the high of the entry pattern based on the pattern 1 teachings. Then add 3 pips to allow for spread in the stop loss. So spread is just what the brokers use to make a profit. So they usually add 3 pips to your entry when you are selling, and they subtract 3 pips when you're buying. So you want to cater for that in your entries. Then aim for 1 to 3 R multiple setups. So that is how you can execute. This is just an example of a trade checklist when you're bearish. So just as an example, we can look at this bearish scenario. So this is a 1 week chart of the Euro USD. The market had hit this premium weekly order block right here. So once we hit that order block, we now drop to the daily chart to see what was going on here, if the market was willing to drop from there. So as you can see, we also had a 1 day premium fair value gap as a confluence to that weekly order block, bearish order block. So once we hit that area, aggressively the market immediately, so once we feel that daily fair value gap, the market immediately started reversing, and this day it's also reversed. So once we took out this lows, we left an imbalance here. So this is the example we're going to be looking at. So the market was already moving lower, and this day it retraced back to hit that daily fair value gap. So from this daily fair value gap, will drop further into the 15 minutes chart to see how we could have capitalized that as an opportunity. So as you can see, once we hit that daily premium fair value gap, we actually took some buy side liquidity. There was this highs here. We also drove higher and took out this. So it kept driving higher. So once it took out this, actually the moment it broke below this low, that is when we were sure now this was a stop hunt, or rather buy side liquidity taken. So the market immediately broke. So we'll zoom in here and see what is going on. But as you can see, this was the New York open session. So once we broke that market structure shift, we will see that we have an imbalance somewhere here that we could have used for entry purposes. So in this example, we'll be targeting this sell side liquidity and potentially this one. So this was a very good area to take partials. We also had these lows here. So sometimes you may not really know that the market will come all the way to this lowest low, but you want to now pay yourself as the market is dropping. So we have zoomed in into this example, and as you can see, this was the New York session. We took out buy side liquidity. We hit that premium fair value gap. There's also that weekly order block that was already hit above the price. So we were already driving low in the weekly chart. So the daily was just supporting. So the daily order flow was supporting what the weekly was doing. So in the 15 minutes, once we hit this imbalance or fair value gap in the daily chart, what you want to see that liquidity being run. We also had this buy side, but the most important thing you want to see is that shift in market structure right there. So once this low was taken out, so as you can see, it went higher, fell short of that midpoint of the fair value gap, then started going lower but failed to take out any short-term loss, then drove higher, taking out this buy side, then dropped aggressively, taking out short-term low, creating a market structure shift, and then leaving imbalances. So this was a clear bank sponsorship from that level. So once you see that imbalance, you enter the market now to retest So this range here is what we want to measure for premium and discount. So you want to measure the high and the low and see that the market should come back towards some form of premium above 50%. Sometimes it may not really get to 50%, so it might use just the area where it shifted structure, like in this instance. Then it will drop aggressively from there. So this was our initial target. We had that other target down here. So the first partial was taken here, where you can pay yourself and leave the rest for the final target. It's always good to pay yourself. So in this example, you're seeing actually you can pay yourself at around 2R. So the stop loss was about 30 pips. And this here is 60 pips. So right there, you could have paid yourself 2R. Maybe take off, let's say 80% of your position, and then leave the rest for the final target. So actually this trade gave us about 3.01 R. Now when we come to the bullish scenario, first of all we'll use the 15 minutes entry pattern number 1 to frame our entry once a discount 1 day or for order block or fair value price hit. So you enter once 15 minutes entry pattern number 1 is confirmed, and as we have outlined, the confirmation is the market structure shift. You enter on the retest of the market structure shift area plus fair value gap. So one of these will give you a very good entry point. You can also consider the premium versus discount scenario I've outlined. Then reduce your risk by using a 15 minutes entry pattern number 1 for entry. And then just buy when the market is moving down into discount as it retests it. So just take the range that took out liquidity, measure that range and find the discount. Then target buy side liquidity on the 15 minutes or previous day's highs. You want to aim for 40 to 50 pips. Aim to catch that daily range expansion. So the stop loss is placed below the low of the entry pattern based on pattern 1 teachings. You want to subtract 3 pips for spread and stop loss and aim for 1 to 3 R multiple setups. So that is the bullish scenario. Looking at an example, we had a weekly order block here that was hit. So this is the order block I'm outlining. So the market had this buy side liquidity so from hitting this point, this candlestick had not formed. So we still had that buy side liquidity as a point where the market may draw towards. We also had this high here that was a potential target. So the market was already going higher after hitting this imbalance down here. So the weekly bias was bullish. So we saw it created imbalance. So we actually outlined this as a bank sponsorship. And then it retested that imbalance and was just continuing higher. So the order flow is just bullish, going higher. So once you saw this order block being hit, you want to frame buy setups right there. So you'll drop into the daily chart to see how you could have framed your entry. So we have narrowed down into that weekly order block, and the market was already going higher after hitting that weekly fair value gap below. And once it hit this weekly order block, the order flow, we were expecting it to continue bullish. So actually, after seeing that the market now hit that order block and responded like this, the next day we want to be buying towards this daily highs, which is our drawn liquidity. So the range of opportunity, as you can see, is from that opening up to this weekly old high. So you also be mindful that we have these highs here. So in the 15 minutes chart, actually the order block on the weekly is right here. So we took out some sell side liquidity back here, and a lot of sell side liquidity here was taken out also. So the market hit taking out this sell side. You can also zoom in and see how it took out some even more sell side that it engineered and created a pattern entry number 1. So let's zoom in and see how that panned out. So you can see how aggressive actually this market moves away from that weekly order block. So this is the example of the weekly order block setup. So once we took out sell side liquidity, the main thing you want to focus on and see as a confirmation is the market structure shift. So we hit that weekly order block, we took out sell side liquidity, immediately we're seeing sponsorship. You can also see it left an imbalance right here, very aggressive actually. Took out that short-term high, creating a market structure shift, and then you want to now enter. As it comes down into this imbalance, that's when you enter a buy. So this was actually, it came in at 9:45 a.m. New York time. So I've outlined this as the first partial because it was about just slightly more than 2 hours. The stop loss was 29 pips. The target was above here, which was 109 pips. But before then, you could take some maybe half of your position off here and wait for the other half to see if the market will continue expanding. As you can see, we took our entry here inside the fair value gap, coupled with, if you measure the range from this low to this high, you'll find that it was below 50%. So I did not outline that here, but essentially this is the range you want to measure for discount, and then you want to ensure that you're entering when it's coming down into discount. So and then you enter and you see how the market will deliver aggressively. So actually this is the kind of movement you want to see in these setups. You want to see immediate feedback and aggressive price delivery. So now that you've entered your trade, the next thing you want to look out for is how to manage your trade. So I'll outline some few examples of trade management, but you can come up with so many other scenarios where, based on now your experience in the markets and based on your preferences, you can come up with how you can manage your trades. But how the basic idea is, you want to have an exit logic. You do not just want to exit positions anyhow. You have to have logic behind it. So the first logic I'm outlining here is the take profit target has been hit, or rather you're taking partials. The second logic is that stop loss has been hit, meaning the trade has gone into a loss. The other logic is that the trade has exceeded a time stop loss. So you have to have a time stop loss. So you go back to your charts, study those setups, outline them and study them in detail. How long do these setups take? How long do they take to deliver? So that you can come up with your own time stop loss that you feel if this time is exceeded, then this setup is not really what I'm looking for. And then if you get an opposing pattern forming in the 15 minutes contrary to your trade entry before the targets are hit, then that is a logical reason to exit that position and wait for more information. So the second thing, you want to always take partials. So take majority of, in this example I've outlined that you should take majority of your position off at 30 to 40 pips or a logical low or high, depending on whether you're buying or selling. So when I say majority, that is up to you, but you can do half, you can do more than half, maybe 60 or even 80% of your position you can take and book your profits. Then you can leave the rest as a runner for any extended move. For risk management, I've outlined, just as we looked at risk management model, I've outlined that you are risking a maximum of 1%, and in case your trade goes into a loss, reduce your risk by 50%, meaning if you're doing 1%, reduce it to 0.5% on the next trade until you recover drawdown. So if you have any drawdown, then make sure you're reducing your risk. In case of 5 consecutive winning trades, also reduce your risk by 50%. So as an example, this is just an example of how you can take partials. So it's just the same example of the trade. So once you take that entry there, and as you can see, your stop loss here was about 30 pips. I've outlined that you can take your first partial at 60 pips, which is about 2 R. So that is how you can take out partials. And then the final target, you can leave your runner. So even before we go there, I can maybe mention that this line represents, oh, actually, as you can see, I forgot to mention this. This is a time measurement that I've outlined here, that you can measure the time taken from your entry, right in this candle, this black candle that went down. That is where I measured from up to the target. So the target actually that I've outlined is 12 p.m. New York time. That is the final time that you want to be taking your profits off. So as you can see, it took 2 hours 30 minutes for this setup to be completed. So it ran all the way, making sure that it delivered and took out those liquidity just shy of 12 noon, to make sure that it had taken off the objectives that the market was aiming for. So you also want to be taking your profits, and actually majority of your profits should be taken just before 12 noon. You should have taken off, or even after maybe it has hit your targets. You want to be off the markets. So this is a sample setup checklist. So I've just come up with this checklist to summarize, or even this is a hands-on now checklist that you can use when you're hunting for setup opportunities. It just summarizes how you can maybe have a checklist to ensure that you are maintaining the rules. So the first thing I've outlined is the drawn liquidity. This is actually basically the bias on the weekly or daily chart. The second thing you want to look at is this a 1 day or 4 hour fair value gap or order block that has been hit. It should be obvious and should be the nearest. Then the session is landed on New York Open. Then you have 15 minutes has hit that 1 day or 4 hour order block or fair value gap. Then 15 minutes you have seen that this is a sell side or buy side liquidity that has been taken and the market has reversed. And then you want to see that shift in market structure, leaving an imbalance. So you seek for entries inside that imbalance, target opposing liquidity, and then use 15 minutes or 5 minutes to fine tune your entries. Stop loss, always place it at the higher low that took out liquidity. So objectives, as we already outlined, but I've used here all the same objectives. The weekly objectives you can have is, in this example, it's 80 pips. But as a beginner, you can start with something smaller and very achievable. You can even do 30 or 50 pips. Between 30 to 50 pips, very achievable. Monthly objective, you can put it as a percentage. Then the R multiple average is 3R. So note that once you hit your objectives, just stop. So this 3R is per trade, this is per month, this is per week. So if you hit 80 pips before even the week ends, you need to stop and do something else, because you can go back and study maybe what the charts is doing, do something else rather than engaging again in the charts. So again, we have the trading rules examples. So this is also something you want to include in your trading plan, that these are rules that you've set for yourself, and make sure you're making it easy to follow, and make sure you're outlining the crucial aspects that will ensure trading success. And also make sure you're following the rules by always reviewing your trade setups. So always review each individual trade setup to ensure that you're following your rules. This is what actually sets you apart as a professional trader. I think we already went through this, but we can mention a few. Always take partials, sell at premium, buy at a discount, always place a stop loss, and ensure that the daily order block of fair value gap must be hit before engaging in any setup. Wait for market structure shift on 15 minutes for confirmation. Always manage drawdown. So you must always have that risk management model. So all these rules you can set for yourself and ensure that you're following them. So as an exercise, I want you to go now with all those concepts that we have taught, everything that we have taught. everything that you've studied in the charts. Sit down, just formulate your trading plan, and what you want to do is keep it very simple. So you don't have to follow the exact example I've outlined here, but the rule of thumb is that keep it very simple. You have to base your trading plan on the concepts that you've learned in this course and that you'll be using in your analysis and trading. Remember, keep it very simple. So actually, look out for a backtesting example that I'll go into even more details, and I'll be doing a live example. So I'll be doing more live examples. I'll be updating the course with more examples that are even more current, that you can use in your, maybe in your studies, so that you can reinforce what you have already learned in this course. So just check out backtesting example, just one example of backtesting, and more live examples that I'll be showcasing the different concepts that we have already learned. So thank you so much for watching. I'll see you in the next lessons or examples, and just go and do it. So check out actually the next video. I'll be outlining what you need to be doing next. So after the course, so this is the end of the course, and by now you should have formulated a trading plan. So that trading plan, once you have it, check out the next video. I'll let you know exactly what you need to do next, so that even before formulating the trading plan, or even after formulating the trading plan, you need to watch that video so that you can know exactly what you need to do next. Thank you.